Hi, welcome to Ask the Mortgage Expert, 2014 edition. This will be our first episode and an episode of many. Today I want to speak about how the 5 ways of getting a mortgage will be harder in 2014. The market's changed, the climate's changed, we knew these changes were coming, but it's going to be a tougher year and it's going to be much tougher to get a mortgage after January 10th. So that's the deadline right now for lenders to fully comply with all the enacted provisions that have been set forth. First outlined in the Dodd-Frank Wall Street Reform Act and the Consumer Protection Act is, first and foremost, this all started back in 2010 in the wake of the crisis known as the mortgage meltdown or the subprime mortgage crisis. They're eager right now to prevent future housing meltdowns and people from defaulting on loans and subsequently foreclosures and property values going down and so on. So legislators back then outlined formal requirements for borrowers seeking what are now called qualified mortgage, otherwise known as QMs, and they designed these different mechanisms to cut the odds that loans will default by substantial amount of percentage. Whether it's good or bad or indifferent, we'll see how that all plays out. So this is all going to turn into one big financial stink bomb, if you ask me. Many banks right now have tightened their standards shortly after the Lehman Brothers meltdown back in the day. But now everyone is encouraged by the law and by Dodd-Frank and Consumer Protection Act to be much more careful. Banks can still offer non-qualified mortgages that don't fully comply with the new rules and regulations, but they're not going to be able to get insurance for them. They're not going to be able to trade them freely in the secondary market, and they won't be protected from lawsuits that are brought by homeowners in a bad place or who are in default and claim that the bank had any type of wrongdoing or any type of malicious undertones. So they're going to show that they weren't properly vetted, which means such loans are likely to be much rarer, in other words. This is definitely a game changer for the mortgage industry. And, if you don't know mortgages, know your loan officer. That's key. Here are some of the new hoops that I want to go through. There's 5 of them, so I'm going to keep it short and sweet, as you know I like to do. Freelancers and self-employed individuals won't be able to get reduced documentation loans anymore. Okay, right now there's 2 or 3 banks that do them. That's going to end. They used to be able to snag approvals for mortgages based on gross income and based on year-to-date income and based on whatever field they were in and what the average income for that field was. So that income, often a higher figure than the net income stated on tax filings, obviously people who own their own businesses, this is all about, usually have expenses that they can write off. So they may gross $200,000, but they write that down to, let's say, $30,000 after all their expenses. So the paperwork was fairly abbreviated for these loans. The interest rates were a little bit higher, but the people didn't care because they wanted those homes. They wanted that cash out. So they used their gross income instead of their net income, basically. So the ability to repay provision for self-employed individuals, along with everyone else, is going to need to go by the adjusted gross income number after all of these write-offs. And you're going to need to see at least 2 years worth of tax and banking documentation, plus anything else banks ask for in relationship to this, or any type of overlays that a bank may have, in order to be able to vet that creditworthiness for that borrower. My assistant Danielle has brought this to my attention, and we have a heavy portfolio of New York City-centric clients, and this is going to be a little bit of an issue because there's a lot of self-employed individuals with creative accountants, to say the least. So everyone's going to have to account for deposits made in their bank, over $500 too. It could be a loan that your roommate gave you. It doesn't matter. If you put $500 in your account or more, you're going to have to show documentation and source and season that money. So if somebody helped you pay rent at one time, you better hope that she kept on to that canceled check so you can prove it came from her and not some sketchy cash transaction, which is what they're looking to vet out. Also, interest-only loans. These loans are going bye-bye. These are among very, very popular loans for New Yorkers who get paid partly by commission. So 1 month they'll make more money, 1 month they'll make less money. We're talking about lots of Wall Streeters We're talking about lots of garment industry workers who often want low monthly mortgage payments, and they'll pay down their principal when comes bonus time or when they get their check back at the end of the year. But it's going to be a big issue right now with these new law changes. 90% of lenders stopped giving interest-only loans already after the Lehman Brothers meltdown, but there were still many investors that would buy these in the secondary market. So we were still able to do these interest-only loans, especially in a city where we're willing to do so, which is New York City. Now borrowers, about 5 to 10% of our business, will just have to wait. They're just going to have to qualify for mortgages like everyone else, and they're going to have to qualify for the comparatively higher monthlies that typical 30-year mortgages with principal and interest demand. So they're going to be saving up for bigger down payments. This is my idea: save up for a bigger down payment, or try to find a non-QM loan, which, like I said, is going to be very hard to find within the next couple of months. Number 3 is fewer loans lasting longer than 30 years. We had the 40-year mortgage for a while, the 35-year mortgage. They do exist. They still exist. And again, they help people maintain low monthly mortgage payments because they're amortized over a longer period of time. So the bank doesn't care. They're making that interest. So those monthly payments in a pricey city such as New York, it was offering 40-year mortgages, at one time 50-year mortgages. So a month ago, we started prepping people, letting them know these things are not going to happen. If you wanted to close on a loan like that, you better do it right away. And we're prepping them for Dodd-Frank's QM must-haves. And plenty walked away from these type of mortgages a long time ago. Plenty more are going to start walking away from them right now. Number 4, your monthly living expenses, meaning your mortgage, your taxes, your credit card debt, and other loans like that, or student loans. Stuff like that you can't account for, is now 43% of your gross income. You cannot go above that. There were a time when we could go to 45 and then have some compensating factors. That's going to end. Now, considering how expensive it is to live in New York, lenders were once allowed, depending on the applicant's credit worthiness and character and history, to push that number to 48%, even 50%. Those were the days of milk and honey, because in New York we understand that housing does have a big part in one's lifestyle here. This isn't Phoenix, but not anymore. One client we're working with right now has $100,000 worth of deferred student loans. That's a big problem. I mean, they're deferred for years, but he's not due to start making these payments anytime soon. But the banks will not lend him money because they take that into account now. It doesn't matter that he's going to have a great job soon. He's a doctor, but they're taking into account now all those minimum monthly payments that he's going to have in 5 years when he's making the money to be able to pay that. So before they even come due, you're responsible for it. Now, if you own a townhouse or a multifamily, they'll be looking at your utility bills as well. That's something that's never happened, but that's what's going to happen now. They're going to be looking at utility bills, and quite frankly, you shouldn't buy anything if you're above 43% anyway, in my estimation. You still want to go out to eat. You still want to have a lifestyle, go on vacation. So some of these rules are good, some of these rules are bad. Finally, number 5, to get this out of the way, if you're getting an adjustable rate mortgage, banks now will be calculating whether you can make that monthly mortgage payment at the fully indexed rate. What that basically means is, right now, on a 5-year ARM, an adjustable rate program, rates are about 1% cheaper. So right now we're 4 3/4. If you wanted to do a 5-year ARM, let's just say adjustable rate mortgage, after 5 years it can adjust. You can get 1% lower in your interest rate. So it makes people easier to be able to afford that mortgage and qualify for that mortgage, to get that mortgage closed. Not any longer. Now what they're going to do is they're going to qualify you with that 30-year rate. They'll still give you that adjustable rate mortgage, but they have to qualify you at that higher rate. So any of the fallout that we've been able to push into that bucket is now gone. Walter Stashen said, he's the president of my bank, he said that banks are going to now be looking for workarounds. They're going to be looking for different ways to get creative to help people who they feel have an ability to repay a mortgage and to help them. So a few lenders have informed them they'll still be in the non-QM game, but I have to be honest with you, there aren't many of them left, and they're few and far between. So if you're deciding to get a mortgage, give me a call right away. Let me go over your options at this point before all the changes take place, and let's see what you can apply for. Thank you guys for watching. Sorry it was a little bit longer than my usual episodes, but we'll be seeing you next week, and we'll keep these things coming to you fresh and new. Have a great 2014, and don't forget to call the mortgage expert for any of your questions. 718-869-4795. Thank you.